Let's take a look at the stock market in today's video. We're moving down into a daily cycle correction, but I think we need to have some realistic expectations here as this progresses, and I don't really think it's done just yet, but we're going to see a lot of analysts predicting, some very scary downside targets. This always happens at these cycle corrections, more so during an intermediate degree correction because they tend to last longer. But there are a lot of signs here that we've completed the cyclical bear market. So generally speaking, I think you can just ignore the people that are calling for a serious crash, anything with a target below the October low. Not right now. Maybe in 2024 when we get our next 4-year cycle low, but not at this point, I don't think. So a couple things first off here. So we've got our first intermediate degree cycle coming out of what I'm pretty sure is a cyclical bear market bottom right here. And that intermediate cycle topped here and it bottomed here. And this intermediate degree bottom, of course, didn't come anywhere even remotely close to dropping below this October low. So that makes me think that we've completed this cyclical bear market. We've made a higher low here. Now we're in the first daily cycle, so a minor cycle embedded within the larger intermediate cycle. And we're moving down into this first daily cycle degree correction. Now, as you can see, our corrections are quite volatile here. This wasn't even a move down into a daily cycle low. This was a half cycle low. Extremely volatile move coming down into this first daily cycle. Pretty volatile ABC correction down into the intermediate degree bottom. And then, we have right translated this intermediate cycle, or this daily cycle, sorry. We've right translated this cycle. It's rallied more than 20 days. So it's very unlikely that this is going to drop below this intermediate cycle low and left translate. But I think it's going to be volatile, so I don't think we're done yet. I don't think it's at all out of the question that we could test 4,000 or maybe even a little lower. And again, let me show you this long-term chart, and this is the reason why we are getting these really volatile swings during these corrections. All right, here's that long-term chart again, and you can see pretty clearly here that all of the QE that central banks did coming out of this March COVID bottom produced this massive rally that stretched price exceptionally far above the long-term mean. And in this case, I'm using the 200-week moving average. One of two things needs to happen when you get something like this. You either need to have a really severe correction that drops considerably, like the pendulum needs to swing a long ways to the downside to compensate for this huge stretch to the upside. That doesn't appear to be happening here. If that was going to happen, I would have expected another bounce here and then another left translated cycle that would come down and make a lower low, and I would have been looking for something in the 3,000 or lower range. That would have qualified as the pendulum swinging to the downside, but it's not doing that. It's going sideways, and I'm pretty sure the reason that this is happening is because the multi-year cycle in the dollar has topped. So we're this corrective action from this extreme stretch is being moderated by a weakening dollar, and I think that'll continue for probably another year still. So instead of getting a really severe correction, something that drops considerable distance below the 200-week moving average. Now we're starting to churn sideways, and it's going to take a lot more months, in my opinion, to work off this stretch before we can, try and make significant new high, get a breakout and a sustained breakout. Now, there is a scenario where this all just gets thrown out the window, and we do start to rocket launch higher, and I'll go over that in just a second here. And it could even happen after this daily cycle bottoms, but generally speaking, I think we are now moving into a scenario where stocks just become difficult. They don't make a whole lot of traction here. You can see this rally out of this intermediate cycle low. It didn't get a lot of traction, and then we had a really volatile correction into the first daily cycle low. Second daily cycle only was able to make just a very marginal higher high before it produced another really volatile move down into the intermediate cycle low. This first daily cycle has not been able to make a higher high. I think the second daily cycle probably will, but it may not make it by much. So generally, a market that's really difficult to make any sustained gains. You just don't have a trending market. You got a very choppy market. And my expectation right now is that this is going to continue for the rest of the year and partway into 2024 until we get our next 4-year cycle low. The last one occurred here in March of 2020. So this one's going to be due somewhere in the spring or summer of 24. And it might even stretch out to the election in 2024. So now, let me go over the scenario where this could all change and we could start to rocket launch higher. So this is the Philadelphia Bank Index, and you can see the financials are in trouble. And as the regular stock market moves down into its daily cycle low, it is, of course, taking the banks with it. And the banks have not been able to make a lot of headway here as the market has rallied out of that daily cycle and intermediate cycle low. And so that means they are vulnerable to making a lower low. And breaking this support opens the door for maybe not as severe a collapse as this, but it could get really destructive. If we break this support and the selling really starts to intensify, if we see another one or two of the regional banks go under, this could really start to accelerate lower. And if that happens, then, right now the odds are favoring that the Fed's going to hike another 25 points next week. But if the banks break support and really start to do some serious damage to the sector again, like they were doing here, then that could come off the table, and the Fed could pause. And if in that scenario, if the Fed pauses, the dollar is going to collapse. Although I will say that it may have a temporary bounce just because it's late in the cycle, and so it would be one of those things where the traders have been selling the rumor, and then they're going to buy the news. But even buying the news would only be temporary, and then the dollar would roll over again pretty quickly and continue down. And that could power a big move up in literally everything. So this is the Philly Bank Index. Now let me show you the regional bank index. And you can see the regional bank index is already broken support yesterday, tried to recover today, but has not really accomplished much here. And so this index is at risk of starting to accelerate to the downside. So now let me go to the Fed Funds futures charts. All right, so this is what the market is pricing in at the moment. It's pricing in a 72% chance that the Fed's going to hike 25 basis points. Now, contrary to what a lot of people believe, the Fed doesn't lead the market. The Fed does what the market tells it to do. The bond market is, other than the currencies, it's the largest, most important market in the world. And the Fed is not going to lob a nuclear bomb into the bond market. And by that I mean the Fed's going to do what the bond market tells it to do. So if the bond market tells it it's okay to hike 25 basis points, then they will hike 25 basis points. If, however, the banking sector starts to collapse and we have some serious destruction in the financial sector, these odds are going to drop below anything below 60%. Becomes very questionable whether or not the Fed will risk tossing that nuclear bomb. Below 50%, and the Fed's not going to raise rates. So we're going to keep track of this. This was at about 98% like a week ago, and you can see as we have started to move down into that daily cycle low, the market is starting to get a little nervous. And if the market tells the Fed that they are not going to allow the Fed to hike another 25 basis points, then the Fed is not going to hike 25 basis points. They will stand pat. They will do what the market tells them to do. It's not the other way around. This is not the market trying to guess what the Fed's going to do. The Fed is watching the market, and they will do what the market will allow them to do. If the market allows them to hike 25 basis points, then they will. If the market tells them you can't hike 25 basis points without creating a major catastrophe, then they're not going to hike 25 basis points. So you want to watch this, and if this goes below 50 by Tuesday or Wednesday of next week, then the Fed's going to pause. And if they pause, then everything is going to take off like a rocket. Stocks will complete their daily cycle low, and then they will rocket launch higher. Commodities will rocket launch higher. Metals in particular, I think, will rocket launch higher. And then, like I said, we may get a temporary bounce just as an excessive sentiment reaction from that. But it will be temporary, and it won't last long before the dollar rolls over again, and then everything again starts to accelerate to the upside. So that's what I'm watching here. We're in the declining phase of that daily cycle in the stock market. This is the S&P. I don't think this is done yet. I'm sure the Fed and the plunge protection team would like to stop this, but I don't know that they're going to be able to here, as the banking sector is becoming very twitchy and is at risk of really starting to accelerate to the downside. And really all it's going to take is one more regional bank to go under here, and things are going to get really hairy. And of course that's going to affect the general stock market as too. It would give us a very volatile move down. Like I said, I think 4,000 isn't out of the question for this decline. There's a gap here at about about 30, let's call it 3,700. We could fill that gap during this decline, maybe test the 200-day moving average, which would be quite a severe move down into a daily cycle low. But because this is right translated, and because this does appear that the cyclical bear market is over, I don't think, even those could be extremely scary, and a lot of analysts are going to be calling for a major crash and a move below the October lows. I'm pretty sure they're going to be wrong, and I don't think stocks are going to drop below the March low right here, this intermediate cycle low. And then once that's done, I think they'll give us another rally. But again, it may just be another one that's really hard to trade. Like hard to pull the trigger at the bottom because this could be so volatile. And then the rally may not get, it may, I think it'll probably make a higher high, but it may not be by much. As you can see, this rally here, it only managed, to go up above this pivot for a couple days before starting the next decline. Same thing could happen here. Really volatile move down, really scary, really hard to pull the trigger. And then the move up, right about as the time you start to become convinced that the coast is clear, then you probably get another top and back down again. So just a continuation of this very erratic sideways churn that is very difficult and hard to trade. So in my opinion, the banks are the key. If they really start to come unraveled and that Fed funds rate drops below 50%, then the odds are really, really high that the Fed's going to pause. And if the Fed pauses, then this sideways churn comes to an end and everything rocket launches higher. Again, maybe temporary, we get a little pullback and then off to the races again after that. But the banks are going to be the key. So that's what I'm watching right now is how the banks are going to handle the rest of this move down into the daily cycle low. And if they become really erratic, I'm going to keep a close eye on that Fed funds futures and see what the market tells the Fed they have to do next week.